Hello and welcome to the December 2018 edition of Mytech U, the monthly educational series for technology and business topics. My name is Nathan Austin. I will be your moderator today. And this month we will be discussing taxes and technology, tax tips to help plan your IT investments. And we're fortunate to have Matt Klein, who is a tax expert from Olsen Thielen CPAs and Advisors, who will lead us through today's topic. All right, but before we turn the presentation over to Matt, I have a couple of notes for the audience, whether you're listening now or in the future. Well, actually, if you're listening in the future, you already know this because it's recorded, but thank you for joining us today. This presentation is being recorded and will be available 24 hours after the presentation. The audience is on mute. However, if you have a question, please use the questions section of the GoToWebinar control panel, and we will do our best to either interject the question into the conversation or we will follow up with you afterwards. So now that the housekeeping is done, with that said, Matt, I'm excited to hear what you've got for us. So please introduce yourself and lead us through the presentation.
Thanks, Nate. Thanks for having me and happy to be here. Yeah, we're going to talk about taxes and how decisions in your investing in your technology infrastructure, what tax benefits are there? And especially with the new tax reform, what can you do? How can you plan around making those capital investments into your technology infrastructure to maximize your tax benefits? So with that, I'm a tax manager at Olsen Thielen. We are a CPA firm located in Minneapolis metro area here. We provide a wide range of services, including tax and financial statements, audit and assurance, and as well as bookkeeping and also valuation. So we're a full service stop here. But we'll dive right into the presentation here. So what we're going to cover is Section 179 and the depreciation rules surrounding technology infrastructure, software, hardware, and we'll also dive into as-service IT models, so monthly subscription services. Those are becoming more popular. Also with leasing, a fair market value lease versus $1 buyout programs. What those look like from a tax perspective, and then also some miscellaneous tax updates because we are under a brand new tax law. So what are some impacts that's going to happen to everybody in relation to the new tax law? Section 179 and depreciation rules. So just kind of setting the foundation here. When you purchase software depreciation, or when you purchase software or computer hardware, the purchased computer software is generally capitalized and depreciated. And so it's depreciated using a straight line method over 36 months. So 3 years straight line, you get the full cost recovery if you capitalize it and capitalize all the costs and depreciate it straight line. Internally developed software, that has a little bit more flexibility. It can be treated as if it was purchased software where it's straight line 3 months or 3 years, excuse me, or it, depending on the nature or the ultimate use of that software, it could potentially be deducted as a research and development expense and eligible for the credit. So the internally developed software has a little bit more wiggle room, depending on what the ultimate use of that is going to be. Computer hardware, that is capitalized and depreciated using the maker's method, which is just the general tax method, over 5 years, so longer term than the computer software. And when you kind of buy a new computer, software costs included with, not separately stated. So if you buy a new Dell computer or whatever, and Windows comes on it, you don't get to break out the Windows piece of it. You just have it all lumped in as if it were computer hardware and depreciated on the maker's method over 5 years. Another item is the tax law gives you a de minimis expense election annually, so it lines up with whatever your internal capitalization policy. Many companies say items over a specific threshold, we're not going to capitalize. We're just going to expense it as supplies or repairs or whatever, what have you. So keep in mind that if you buy a computer and if you can go up to, the IRS allows you to go up to $2,500 per item if you do not have an applicable financial statement, which is an audited financial statement. Or if you do have an applicable financial statement, you can go all the way up to $5,000 per item or per invoice basis and expense it and not have to capitalize it. So if you buy a $2,000 computer, then you could expense it under the tax law under this de minimis election.
So, Matt, before you move on, one of the things that I have found, if you can go back, yeah, thank you. Can you hit? So, I'd like to hit on the research and development expenses because this is actually something that I remember Mytech being exposed to. I don't know, somewhere in the last 3 or 4 years, and we didn't even know it even existed. So, can you elaborate a little bit on what that means? And I mean, candidly, for most of the people that we work with, and they're probably ever going to listen to this, it doesn't apply to most of them, but there will be a subset of them that might apply to. And so could you just elaborate on that a little bit? Like, what are the nuances of what you mean by that, and how does it fit into or not into some of the capabilities? And again, I know that you're giving general tax advice, not specific components. So could you elaborate, though? Thanks.
Right. So research and development, it's eligible for research and development expenses are eligible for credit. And generally speaking, the research and development is any time you're trying to take a new product or process and develop it or improve it or greatly modify it, not just test it or maintain it, but to develop new or greater efficiencies or bring a new product to market. So really what this is kind of more targeted towards, such as Mytech, where you guys may have proprietary software that you allow your customers to use. So, but what it probably doesn't relate to as much as if you're trying to build your own internal use software. But if you're trying to develop software that you're going to use or sell to your customers or allow your customers to use, then it's probably in that research and development category because you are bringing a new product or developing new efficiencies related to that.
So yeah, thank you. So if we're really, to summarize it, if we're really just using that for maybe internal efficiency or internal operations, it probably would not apply. Again, I know generally speaking. But if it's something that is maybe client-facing or something that's a client deliverable, or it's a product that we're selling or offering, that could potentially fit into the research and development bucket.
Correct. Yep. That's a perfect summary.
So that makes sense from a software development. I know I'm thinking of a few of our clients that I believe have different arms where they do that, where this could apply. But I'm wondering about, we have other clients that are maybe more in the manufacturing or device space. Is there anything there is that applicable similarly, or can you?
It's not limited to just internally developed software. Your research, anytime you're developing, you're taking your manufacturing process and say you're developing this product and you're manufacturing it a certain way, and anytime you take that process and say, all right, let's take a look at it, flip it upside down, let's see if we can get this product out quicker, cheaper, more efficiently, and you don't even have to succeed. In fact, it's probably better if you fail, because you just have to show that you had this hypothesis, you tested it, if it failed, why did it fail? Did you retest it? And document all of that, and then you can allocate, employee wages that are sourced to it, direct materials, a certain percentage of contract expenses. Research and development is a very valuable credit, but it's hard to do it on the back end. It's difficult to go back and revisit all of those projects, 9 months, 10
Yes.
months after they happen. So
That makes sense.
we always tell our clients to have, if you know something is going to be kind of more research and development focused, try and document concurrently as you're going through the process, because that is a requirement to take the take the credit on those expenses.
Thank you. That's it. And the next question I was going to ask, you already answered, which is like, well, what are some of the things you can allocate to it? And I really appreciate because I remember that was exactly the situation Mytech was in, by the way, is that we didn't know about the credit, and so we were trying to reverse engineer. Well, how do we potentially know whether or not this is, and should we be allocating stuff? And if we had gone into it knowing, we could have then compartmentalized or made sure our documentation helped us support the credit. But so no, that's good. I thank you for elaborating on that. It's one that I've, at least from my perspective, not many people know about. Maybe more people know than I realize, but I appreciate you elaborating on that. So thanks.
Certainly. So now we have so we talked about kind of the baseline treatment of these costs to acquire IT software or hardware. But now there's also a couple other provisions where you can accelerate that deduction into the current year or the year in which you acquire that asset. So we all are probably familiar with bonus depreciation. It's been around for quite a while. Before the Tax Reform Act, it was set to fully expire at December 31st. But now, after the passing of the tax reform bill, it has been expanded until I think it's 2025 or 2026 or another 8 or 9 years. And it's even been enhanced. So for tax years beginning after 12/31/17, bonus depreciation on qualified property will be increased to 100%, whereas previously, I believe in 2019 or 2018, it was 40% only. So it's been really enhanced and expanded, and it even allowed you, when they passed the bill, it even allowed taxpayers to go back to basically the last quarter of 2017 and apply these new depreciation rules. So that's a huge advantage when you're trying to decide should you invest more or accelerate investment into the current year of new computers or any type of capital asset, knowing that you could have 100% write-off and tax benefit of that amount. So bonus depreciation is huge, and previously it only applied to new property. Now it's been expanded to new and used property. So basically, it's the taxpayer's first use of that asset that would qualify for bonus depreciation.
So and how does that?
Go ahead.
I'm sorry. Well, I was going to ask a question of so you mentioned you started this section with Section 179, right? So how is first? And forgive me for my ignorance, but is first year bonus kind of a subset of Section 179, or are they completely different things?
No, it's part of the depreciation. It's called 168. It's in Section 168, which is your depreciation section. So it's different than 179, but bonus depreciation and the reason why you think it's Section 179 allows you to write off up to a certain dollar amount the cost of certain assets, whether they're new or used, and now that bonus depreciation allows you to write off 100% of the amount of new or used property. They kind of mirror each other, but what the difference is that qualified improvement property is no longer eligible for bonus depreciation, and also bonus depreciation is on a class-by-class basis. So, and each asset class is a year. So all your 3-year assets, all of your 5-year life assets, all of your 7-year assets. If you want to take bonus depreciation on one 3-year asset, you have to take bonus depreciation on all your 3-year assets.
Gotcha.
So there's not, whereas Section 179, as I'll get to in the next slide, you can pick and choose assets there. And so it's much more flexible.
Gotcha. Okay. Good to know. Thank you for the clarification.
So Section 179 expensing. Previously, taxpayers could expense up to $500,000 of business property placed in service during the year. This was indexed annually during inflation. Now, and then it also phase out when your total additions exceed $2 million. So very, very, very high ceilings. Previously, there was a lot of room for companies to take advantage of Section 179. Now, they've even made it larger in the sense that you can now expense up to $1 million of business property with a phase-out threshold of $2.5 million. And again, as mentioned earlier, there's flexibility with Section 179 in applying specific assets versus asset classes with bonus depreciation.
Is there on this I'm going to bring up something that might be phased out or something, but I remember at one point that there was is there so this is the total dollar amount. Is there on an asset by asset basis, is there a limit to the, or is there a minimum threshold or maximum threshold of an individual asset that applies to 179? Like I remember we bought a whole bunch of when we had invested in some office furniture, and there were some rules that we had to follow relative to the cost of some of the pieces of the like I don't know. There's something there. Does that have anything to do with 179?
Yep. So that probably goes back to your de minimis policy.
Okay.
So for books, if you spend $1,000 on an item, you don't need to go to 179 to expense it. You can expense it under your de minimis policy.
Gotcha.
And so that, sorry, excuse me, I'm coughing.
No, it's good. Yeah.
And so there's many different hurdles, I guess. So once you get, say your first thing is going to look, well, is this under my de minimis threshold of capitalizing? Do I even need to capitalize this for tax? And tax says, as long as your book policy says you can, it's under $2,500 or $5,000. What if you have a financial statement, depending on what bucket you fall into? If it's under that, you can expense it under the de minimis threshold. If it's over that, then you capitalize it, and then you look at these depreciation rules and say, all right, well, now I have to capitalize this. How do I maximize my benefit? Is it Section 179? Is it bonus depreciation, or do I not take either of them and take the normal maker's life?
Gotcha. Yep. Makes sense. Thank you for clarifying that. That helps me connect the dots. Yeah, that helps me connect the dots across those different variables. Appreciate that.
Certainly. So optimizing, people always say, sure, I'd love to take an asset and write it off and right away when I buy it and get the benefit, but there is an optimization. There is some games to play with these rules to make sure that you're getting that deduction at the highest possible tax rate. And so how you can do this is really with Section 179, you got some flexibility in choosing your asset on an asset by asset basis versus all or nothing. I call it all or nothing bonus depreciation, where if you want to take bonus depreciation on one asset, you got to take it all assets in that class. And also help knowing what tax brackets you're in and projecting out what tax brackets you're in the future can help you analyze this decision on whether or not to accelerate the tax deduction on these assets.
Which one makes sense, short term and long term. Yeah.
Right.
Exactly. Yep.
Also, I'll get into a little bit briefly. This is a little bit outside of the scope, but when you take accelerated depreciation, you're reducing the amount of your qualified business income deduction, which is a new 20% deduction for pass-through entities or sole proprietorships. But I'll touch on that a little bit later. And that new rule could have a whole nother webinar on. So that's just a caveat there to keep in the back of your mind. So I'll run through an example here. There's taxable income before depreciation of $500,000. Say you have $150,000 of computer additions and software additions of $100,000, and say you write off all $250,000 of those additions through bonus depreciation in the first year, that drops your taxable income down to $250,000 for the current year. And then if you don't acquire any more assets, you're done with depreciation for the foreseeable future. So you get that tax bump in the first year, and so total taxes over this 6-year period here is $680,000 on the having $500,000 of income before depreciation during those 6-year period. Excuse me. And then here's another example of just how kind of planning and playing it's kind of a game, seeing what happens if you don't take accelerated depreciation. Say you just capitalize it and let it run off its normal life here. You still have $500,000 of income before the depreciation. But say you don't take any 179 or bonus depreciation, you just take the software over 3 years and the computer is over 5 years, you actually reduce your total taxes over the 6-year period by about $9,700, because what's happening is that when you take that $250,000 accelerated depreciation, it kicks you into a lower tax bracket. And so your deduction is offsetting income that would be taxed in a lower bracket, versus if you were to spread it all out over the 6-year period, and take it all in that same higher bracket, if that makes sense.
No, that's the example. What you're saying is like understanding your current tax bracket and potential future tax brackets, and then trying to make a decision for what's best for your business, right? So,
right, and these examples are kind of the two ends. It's either all or just take it over your 5-year period. And so what we do with our clients and just kind of have a long-term strategic discussion when they make big capital purchases, and completely overhaul their IT structure, or whether it's a manufacturer or buy a brand new piece of equipment, seeing what the future holds, and also probably taking a look. The answer is probably somewhere in the middle.
Yeah.
So that's kind of important when you're deciding to accelerate large capital purchases.
Mm-hmm.
And again, if it's you probably want to do accelerated if it doesn't kick you into a lower tax bracket. So it's also important knowing where you're at today, and also where you're gonna be at tomorrow.
Well, and I imagine too, like I think about, and I know that not to dig in too deep, but just as an example, any given business, like maybe this year, hypothetically speaking, they intend on making, depending on where their tax bracket comes in, or their income comes in, or what investments they're looking to make, it might make sense to, even though they might save $9,700 over 5 years, they might need or want to use the money now. So they might want to take the accelerated depreciation, not because it saves them money, but because the here and now they want to use that in a different way.
Right. Yeah. And with the 3-year and 5-year life assets, time value of money isn't a great factor. So, you're not looking at a 15-year asset. So the recovery period, if you don't accelerate it, it's a relatively short period. So that time value of money isn't a huge factor.
Yeah, totally.
Software as a service. So this is obviously getting more popular. Amounts paid for these for these as service IT products are generally deductible as paid. You're using the software, you don't own the software, you just have the right to use it. And generally the software is on the cloud, or a server which the user has zero control over. So you get benefit to deduct those amounts payable, whether it's an annual subscription or a monthly subscription, or what have you. And examples of this is like your website domain registration. If you have a website or a web-based application hosted on AWS or any other cloud platform or virtual server. Any third-party cloud-based storages or any other online tools and apps that you use. One pitfall that is getting much more complex in this area is sales and use tax. So each state treats these software as service products differently. So my advice is to talk to your tax advisor and make sure you're appropriately paying sales tax or use tax on those products because the states have kind of picked up on the amount of revenue that these companies are generating by selling these products and making sure that the appropriate sales and use taxes are being applied to those services.
Yeah, that's a great point. So basically, software as a service, or any type of as a service subscription stuff that you don't own, you're just using or renting, kind of almost. It's just a straight expense. I mean, this is just
exactly.
Yeah.
Yep.
Yep. Makes sense.
So leases, fair market value versus $1 buyout. So fair market value are generally cheaper. You don't have to retain the equipment at the end of the term. It's generally a fixed monthly payment, and it's considered an operating lease. So the entire lease payment is tax deductible as an ordinary operating expense. $1 buyout leases, so that's kind of as if you were financing the purchase of the equipment. So it's a higher monthly payment. At the end of the lease term, you have it's a bargain purchase option, and we generally see this when obsolescence isn't a concern, because obviously if the lease is for 5 years, and especially in the technology world, obsolescence is a huge concern. So if you're not worried about whatever you're leasing becoming obsolete when your lease term is up, this is probably one of the routes you can go. What happens is the present value of the lease payments are capitalized on the balance sheet and depreciated. The principal portion of the monthly payments are not deductible because you're getting that payment. You're getting the tax benefit through depreciation on those principal payments, essentially by capitalizing those, and the interest portion of the payment is deductible. This is kind of interesting. Because you're capitalizing and placing in service the present value of the lease payments, you can technically take Section 179 on the amount that you're capitalizing, and it provides you with an immediate tax benefit with little initial cash outflow. So you're effectively financing the purchase of that asset and getting the full deduction when you take possession of it.
Yeah, that's what I was going to ask. So it sounds like you can presuming it falls under the Section 179 rules, you can depreciate, like if you had a four-year dollar buyout lease, you could depreciate all of the cost of the 4 years in year one?
Yep.
Is that, okay, that's what I thought you said. Yeah, so you can take full depreciation if you want up front if it's a dollar buyout lease versus if it's a fair market value buyout. But basically, it's an OpEx expense, just like software as a service.
Right. Yep. And it's very similar to say you take a loan out to purchase equipment. The loan is paying for the equipment. It's no cash coming out of the business, but and when you take possession of the equipment, you place it in service, you can accelerate the depreciation on that. So it's the same exact philosophy as if you're financing a CapEx purchase. Gotcha.
Very good. Thank you. Good
clarification. Here's kind of an example of what it looks like. So this is a fair market value lease. Say you have an annual lease payment of an equipment of $30,000. You get the $30,000 over the lease payment over 5 years. Your total taxes is $705,000 over that 6-year period. I just kept the 6-year period in there, and it's completely flat because you pay a fixed amount each month for the life of the lease term. And the $1 buyout lease. So here I just decided, well, let's take let's section 179 $100,000 and depreciate $50,000 over the 5-year life. What does that look like? And it's very similar. It's just a little bit higher, about $1,000 or barely $1,000. And but the benefit is that you're getting $100,000 deduction without having to pay for it yet, because you finance that lease through the $1 buyout.
Yes, so you're saying that from a tax benefit, your actual fair market value gave you better cash flow, and it just a little bit better tax advantage versus the dollar buyout. Is that basically what I?
Right. Yeah. From a tax perspective, the fair market lease, because and then it's just in this case that the $30,000 is all getting the deduction is offsetting income at the highest tax bracket. So you're spreading out the deduction over the higher consistent tax bracket, whereas in the $1 buyout, you're taking a larger hit, and you're reducing some income that's taxed at a lower bracket. But the real benefit is that you're getting a tax benefit, a real dollar tax benefit when you file your return, without having to fully expend the funds to buy that equipment, if that makes sense.
So it's interesting. So, because that was one of the things I was trying to, when we talk to our clients, and again, whether it's technology equipment or some other piece of equipment that you need for your business, one of the things that I didn't really fully understand, like which one would play out better. And so part of it, it sounds like with this example, on one example, it doesn't matter because it's actually so close as far as total tax implications that it's really just a business decision. And then the other one could be if I need the additional depreciation. Let's say hypothetically speaking, my business needs additional depreciation now. I could possibly benefit from a dollar buyout lease because then I can take the 179 or other bonus depreciation now. Versus spreading out over time. But either way, it gives me that flexibility. So that's actually really helpful because that's something that I know we struggle with as far as, and I know we're not tax advisors and we're not trying to tell our clients how to do their taxes, but we're trying to understand how we can help have that dialogue. And so hopefully I really appreciate you putting the examples here because I think it really gives clarity to it's not really a huge tax decision unless one versus the other fits what your business needs at the time.
Exactly. Yeah. I always like to say, don't let the tax tail wag the dog. But if you're having a bang out year, and your income is going to be way higher now, and you're doing year-end planning, and you want to lower that liability, and that you've got enough room in your higher tax bracket to get the most bang for your buck. On a Section 179 deduction, a $1 buyout lease is very appealing because you take possession of the asset, you place it in service before year end, and you haven't made, or maybe you made one down payment on the lease or what have you, so you haven't spent the full amount of your deduction. So that's the real benefit there.
Yeah, very good. Yeah, thank you. This is great. I probably stole your thunder on the next slide of the summary.
Oh yeah, no, that's totally fine. This is just kind of a little summary of what I've already discussed. So with the fair market value lease, you've got probably smaller rental payments. You don't have to retain the equipment. You've got protection against obsolescence, and it's an operating expense deduction as the lease payments are made. With a $1 buyout, you've probably got a larger monthly payment. You take possession at the end of the lease term for a bargain. You've got exposure of obsolescence because you're going to take possession of it, and it's a potential write-off of present value, but it's a potential write-off of present value of the monthly payments, and immediate tax benefit with minimal initial cash outflow. Of course, with depreciation, I always have to say, look out for states. Many states have their own depreciation rules. So when you're taking Section 179 or bonus depreciation, know what state you're in and their specific conformity or non-conformity with the federal rules. So Minnesota, I have listed here, this is just Minnesota's rules. Section 179 is limited to $25,000 with the investment limit of $200,000. It does not allow bonus depreciation, and how it handles that is so Minnesota gives you $25,000 if you go in excess, or if you take any bonus depreciation, you add back 80% of the excess and take 20% of that amount you added back over the next 5 years. So many states have their own little depreciation rules. Just be aware so that when you're trying to determine what the real benefit is, make sure you may not get benefit for the same benefit for the state as you are with federal.
All right, Matt, so I'm going to put you on the spot. I'm assuming you probably don't know the answer off the top of your head, but so Mytech works basically with a couple states. We work with Minnesota and with Colorado. Okay. Obviously, you're more familiar with Minnesota because that's where you're based, but do you know, and I appreciate just generally saying, so folks in Colorado that are listening to this, obviously you want to check with Colorado state law, but do you have anything that you know about Colorado that you can mention right now?
Not off the top of my head, I don't. I would have to go look it up, and it's pretty easy to look up. The form instructions generally say.
And their CPAs will know that,
and the CPAs will know. Off the top of my head, with Colorado, I do not know.
Okay, I kind of assumed that'd be the answer, but I thought I'd ask just in case. And I should have warned you.
That would have been a good softball. You should have gave me Colorado, and I could have sounded really smart.
Sorry about that.
No problem. Oops. All right, so here's some miscellaneous tax updates. Obviously, corporations. This is kind of talking about the new tax law we're under. C corporations are now taxed at a 21% flat rate. Previously, system was a bracketed system topping out at 35% rate. Also, the corporate alternative minimum tax has been eliminated. This is to help ensure that the effective tax rate on C corporations do not rise above the 21% rate, and also because there's no AMT, that frees up some of the research credit, and also state taxes at the C corp level, the corporate level, are deductible. As you may know, individual state taxes are capped at $10,000, so you only get a federal deduction for up to $10,000 of your state taxes. Whereas C corporations, you still get to deduct whatever you pay. Here's that 20% deduction. This, because Congress reduced the corporate tax rate, many businesses in the United States are organized as either partnerships, S corporations, or sole proprietorships, where the entities themselves don't pay tax, but the owners do. It passes through the income to the owners, and the income is taxed at the owner's rate. So because they reduced the C Corp rate, Congress had to do something to address this to avoid everybody becoming a C Corp. So what they did, they enacted this 20% deduction on qualified business income. This is a deduction at the individual shareholder or partner level, and what it does is it effectively reduces the highest rate on qualified business income in 2017, where it was 39.6%, whereas if you get full benefit for this deduction in 2018, your highest marginal rate on qualified business income is now only going to be 29.6%. So that's a big rate cut on those types of items. What is qualified business income? It's basically your U.S. trader business, excluding any investment income, so your short-term capital gains, your long-term capital gains, interest, dividends, etc. And it also does not include any wages or guaranteed payments that shareholders or partners pay to themselves outside of the business for services performed or anything of that matter.
Salary or something like that.
Salaries, yep, exactly. It does not include those types of items. It's generally, so there are some limitations. The deduction is limited to, because Congress wanted to grow the wage base, and grow taxes by increasing its base. They wanted companies to pay the workers more. So kind of to mirror that policy incentive, they enacted this limitation where the deduction is limited to the greater of 50% of W-2 compensation paid by the entity. So in order to get the full 20% deduction on your qualified business income, that 20% deduction has to be less than 50% of your W-2 wages. So you want to pay as much wages to your employees as possible to make sure you're getting this benefit. What about certain industries such as real estate, where real estate developers don't have a lot of wage income? Congress said you can take 25% of the W-2 compensation plus 2.5% of the unadjusted basis of the assets. So that looks at their capital spending. And again, the whole policy incentive was to grow the wage base, spur spending and investment in the United States. So this kind of limitation, making sure that you are following those initiatives, you got to follow those initiatives to get the deduction, is kind of the 10,000-foot view of it. These thresholds that I just discussed, they only come into effect when individuals, the shareholders or the partners, are above $315,000 from their taxable income is above $315,000 for married filing joint, or $157,500 for all other filing statuses, so single, head of household, married filing separately, etc. Once you start getting limited, it greatly devalues the 20% deduction. So year-end planning is very crucial with your CPA to make sure that you're not going to get limited on this deduction. Here are just some tax rates, kind of the comparison as to what was scheduled. There's less tax brackets, and also they're spread a little bit wider. You can see that the highest rate at the individual level is now 37%, whereas previously it was 39.6%. Some personal deductions that are getting reduced. Again, I mentioned earlier, your state and local tax deductions are getting limited to $10,000. There's new limitations with mortgage interest. You get limited. You can only take up to deduct interest up to on $750,000 of acquisition indebtedness. Previously, it was I believe $1 million, and any previous mortgages executed before 12/31/17 are grandfathered in. So this really applies to mortgages in 2018 and going forward. And home equity indebtedness is so HELOCs are no longer deductible unless you trace that interest to another deductible purpose, such as investment interest, or you put it as improvements into your home, then it could be deducted. But if you're taking home equity out, a line out on your home to purchase a new boat, that's no longer deductible. The limitations on charitable deductions have increased from 50% to 60%. Personal casualty losses are no longer deductible, with the exception of disaster areas for hurricanes, etc. Medical expenses, the threshold has been expanded for another 2 years. All 2% deductions, all 2% miscellaneous deductions have been repealed. This includes tax preparation fees. So, yeah, us CPAs didn't get good enough lobbyists in Congress for that. And any alimony is no longer deductible if the agreement was executed after 12/31/18. So I guess if you're thinking about getting divorced, make sure you have that executed. Yeah, you got a few days to get that executed. Otherwise, the alimony paid will not be deductible. And also moving expenses are not deductible anymore.
Yeah, real quick question on the charitable.
Yep.
I'm guessing when you say 50 to 60%, does that mean of their annual income? So like if you have
AGI, yep. So you cannot get a deduction if your AGI is $100,000 and you want to donate, $70,000 to a charity. You're only going to get a deduction in the current year for $60,000. The remaining $10,000 is going to get carried forward till next year.
Okay, that's I assume that's what that meant, but I just, not that most people are donating more than 50 or 60% of their income, but I just thought I'd make sure I understood what that meant.
Yep. And then also research and development costs. There's some changes coming after 2021. Certain R&D expenses must be capitalized and amortized over 5 years. The credit is still in effect, though. And then here's kind of our discussion earlier. What are R&D expenses? We kind of touched on this earlier. I won't go over it. You can look at the slide if you need to refresh yourself. And then also here's what they do not include. So research, marketing research, and just modifying or adapting existing business components. And again, we kind of touched on this already. I won't touch on it. I'll leave it in the slides for reference. And I think that's it.
Yeah, no, that's it. That's good timing. We're probably we're 2 or 3 minutes over, so thanks for sticking with us. And Matt, I want to say thank you very much. But before we sign off, I do want to note that one of the things that we found very popular, we've had a lot of the sessions have been booked fully, is that we have the Microsoft Office 365 immersion experience. We do these nearly every month in each one of our locations in both Colorado and Minnesota. And there's only 10 to 12 seats available at any given time. You can kind of see the picture of the room, and it's a guided tour. I mean, we walk you through it. So, and most, for one, every nonprofit gets this stuff for free. So if you're a nonprofit and you're not using this stuff, or you have it and you don't even know that you've got all these things available, we'd love to have you join us. And secondly, if you're a for-profit and you're already using O365, you're probably already paying for this stuff, and chances are you're not using it to its fullest extent. So we'd love to have you in either Minnesota or Colorado, and more dates to come. If you check mytech.com/events, you will always see the most recent schedule of sessions. So thanks for that. And then if you advance one more slide there, Matt, we'll sign off. So I do want to say thank you very much, Matt, for putting all this together. I really appreciate that not only you provided the details that people can reference in the slide deck, but you also gave examples, because I think that really helps people kind of cement. I know it helped me cement my understanding better of the variances and why, and some of the nuances of why you might choose one plan or one method versus the other. So thank you. But do you have any final thoughts before we sign off?
No, just thanks for having me, and feel free to reach out with any questions.
Yeah, and we put Matt's information here on this last slide, so feel free to email Matt or myself, and also we put Matt's phone number there just in case as well. So thank you, everyone who either watched today or are watching in the future. Hope this session was valuable. And again, we are generally speaking about taxes, so you need to talk to your CPAs to figure out how this applies to you. Thanks for being a partner, and we'll talk to you all soon. Have a great day. Thanks, Matt. Bye.